Good boy. What's up, you guys? I'm Dan. This is Frugal Not Cheap, and today we'll talk about investing at all-time highs and other stupid things said in the media. Recently, I'm not sure why, but I've been seeing a lot about sort of this all-time highs phrase being used a lot in YouTube channels and some of the financial media as well. I guess because we had a pretty good October, rebounding from some losses in the stock market in September. So we saw some increases in the S&P 500 to new record levels in October. We also saw some rises in the MSCI Europe and in the MSCI Asia as well. And at first glance, I can kind of understand the psychology behind the phrase. So if we're talking about an individual stock, and we were saying, well, this stock right now is at all-time highs, say Tesla, right? Right now is at over $1,000 a share. It's never hit this price before. It's as high a valuation as we've ever seen. Then I can understand why someone might say, well, why would you want to invest in it now? The time to invest would have been, when the price was much, much lower. I can kind of understand that. But this kind of logic doesn't make any sense at all when we're talking about long-term investing with index funds. So again, Tesla is a very small share of my portfolio. I just invested $1,300 in it back in 2019. The rest of my portfolio is all in well-diversified index funds that follow the global market cap. So there's 60% US stocks and 40% international stocks. And amongst those US stocks, they're divvied up by the market capitalization of those companies. So the biggest companies I own the most of, and then I also own, little slices of the smaller and smaller companies and mid caps and what have you. And when we look at index funds, and the benefit of all that diversity, by the way, is because it gets rid of the risk. It gets rid of needing to try to pick a winner, right? If you're choosing all of your stocks yourself, not only do you have to know which ones are going to be the winners, you have to know which ones are going to be the losers and when to drop them. And you could always be wrong. In fact, people's track record in stock picking is terrible. Money managers' stock record in stock picking is also terrible. Even hedge fund returns are really not all that great on a risk-adjusted and cost-adjusted basis, especially when you factor in the costs against just straight-up index investing. It's pioneered by Vanguard's John Bogle. So that's why I'm all in on the indexes. But more importantly, see, we invest our money in order to obtain a return, right? So if I'm investing in these index funds, I expect to obtain a return, and I expect to continue to obtain a return over time. So when we look at a long view of the performance of index funds, let's take a look at, say, the S&P 500, because then we have a really long view, right? These will be the 500 largest companies in the United States. As the company's market cap falls a little bit below some other company, then a new company can come in to replace it at the bottom, and so you've always got fresh blood coming into the index. But anyway, when we take the long view of the S&P 500, you can see it's actually spending most of its time at all-time highs. And so being afraid to invest at these all-time highs is pretty silly. And this is just another way of saying that when we look at the broader stock market, it's really, really difficult to time the market. Much more important to have time in the market. So this all-time highs thing is another kind of it kind of strikes a little bit of fear in you, right, I guess. It gives you the sense that things are overvalued and are about to fall and probably crash. And so that's why it's an effective headline. But it makes absolutely no sense in terms of your investing behavior, right? So I'm always investing at all-time highs. In fact, that's because the stocks are typically at all-time highs all the time, right? So I just have an automatic investment set up. And as soon as my income comes in, I keep some, of course, in my checking to pay for bills and day-to-day and what have you. But all the rest of it gets funneled immediately over to my 401k, my Roth IRA, and my brokerage account as well. And it's automatically invested, so I don't have to think about when am I going to convert the cash into stocks, right? When am I going to buy? No, it's all automatic. I don't have to think about it because that's really the best way to do it. The best time to invest generally is now because we don't have a crystal ball and we can't pick that perfect time. So along those lines as well, you'll hear the phrase buy the dip. And again, if you're an active day trader and you're trying to gamble and this kind of thing, then it makes sense, right? that you'd want to like try to buy low and try to sell high. That's really the strategy of a trader. And actually, I'm a commodity trader by trade. That's what I do for my work. But I'm a different one. I mostly do risk management stuff using options, so it's a little bit different. I'm not a speculative trader like what I'm talking about here. But anyway, buy the dip, and also, this fear around all-time highs. Both of those things are things that are said in the media and don't make any sense when you're thinking about your long-term investment, say for retirement. Another one that you'll hear all the time in the media is that this time is different. Right? Yeah, this has happened many, many times. We had a period in the 1920s when people thought that there would be no more war and that we'd have a very, very stable period. And as you know, what followed the 20s was not a stable period. We had the crash of 29, and then we had later on World War II. And it's not until recently that we've had relative global peace, the so-called Pax Americana. Then in the 1990s, everyone thought it was different in terms of the booms in Asia and in Latin America as well. And of course, we saw later a crash of the Asian tigers and what have you. And then I think, was it in the 80s or 90s? I don't know. There was a Time magazine cover, maybe the Time magazine. I'll put it up on the screen. But there was a magazine cover titled "The Death of Equities," right? So this is the idea that all of a sudden stocks are no longer the thing to do. But the idea that it was all of a sudden not going to make sense to own parts of companies, come on, that just doesn't make any sense whatsoever, right? Obviously, we would want to own part of companies which, the whole job is to make money, right? They're to make a product, but they're to make money, or sell a service, but they're to make money. So of course we want to own companies. And then in recent memory, of course, you have, this period of growth between 2003 and 2007 and rampant home price appreciation. And you had people that people thought were really, really intelligent, like Fed Chairman Alan Greenspan, saying that things are different now and that these crazy valuations we were seeing in the housing market were completely justified. The reasons that he cited were increased globalization, meaning that we wouldn't have so much sort of at-home risk and things are more systemically stable. Also advents of financial technology. And he thought these things might prevent a crash, but of course, in hindsight, we know that wasn't true at all. This time was not different, and there was a asset bubble, right? There was a giant bubble in credit default swaps and collateralized debt obligations and CDO squareds. Another thing you might notice about the media is they tend to only report negative news. This is something that I talked about in an old video called "Don't Listen to the News When Investing Long Term." I'll put a link to the video below. But basically, it's the fact that we are much more attuned to look at negative information rather than positive information and remember it. And of course, the media is going to use this in order to generate more clicks. And so that's one reason why we see a lot more of these clickbaity negative headlines out there. Here's another one that really gets me a lot of the time, is that in the financial media, they report about individual stocks, like say they might report on Tesla. I keep going back to Tesla because, well, it's very popular and I'm a shareholder. It's the only company that I own individual shares of. But what they'll do is they'll talk about what happened with the Tesla share price on any given day, but they never talk about it within any context. So the thing about it is that the share prices for companies within an individual sector tend to be positively correlated to some degree, especially on a given day, right? So maybe in the longer term, like there are going to be some companies that outperform the sector index and some that underperform. But generally, so when you look at a group of tech stocks, say, like the NASDAQ is a tech-heavy index, and often you'll see the Tesla price increase at times when the overall valuations for tech companies are increasing. In other words, the NASDAQ is also increasing. Or you might have a bad day for the NASDAQ and everyone's like, oh no, Tesla stock is crashing or falling very rapidly. But they don't talk about the underlying trend because a lot of that on that day might have been explained by a sharp decline in the NASDAQ. And while we're on the topic of Tesla, I think it's, well, we've seen that there can be a pretty heavy bias out there in the reporting. And I don't know, maybe over time I've just kind of noticed this more and more because of the increased polarization that leads to more engagement with viewers. I don't mean that necessarily on YouTube, although I'm sure that happens, also on Facebook, but even in the media. So what I'm talking about is how you've got Fox News pretty far on one end of the spectrum, I guess to the right, if we're talking politically. Further than that, of course, you've got like the Alex Joneses and Breitbarts and what have you. And then, well, on the other side, you've got, say, even CNN has gotten a little bit, kind of out there on the left side. And so, you have these two very, very different versions of events, and it's really hard now to parse what's actually going on, where I think there's a lot more journalistic integrity beforehand, with things kind of being a little bit more centered, or at least feeling more centered, I'm not sure. But anyway, one of the reasons why this could be happening is, again, because of all that choice and the really, the easy way it is to kind of like click onto one website versus another. And so if the two sides are kind of pandering to that side, then it tends to work out now. Whereas in the past, you'd want to kind of move towards the center to try to capture viewers from both sides. But as the viewership becomes increasingly polarized, then it no longer makes sense to be centrist, and it makes more sense to move over to one wing or the other. With Tesla, the bias tends to be more sort of from people that might be more aligned with the interests of, say, the legacy automakers, or any of the people that have a large short position in Tesla, or that are pro-union, perhaps, because Tesla is not unionized either. But a lot of it really is with Tesla just the fact that the negative headlines make a lot of news, and the positive ones don't. So, for instance, there was news about this allegedly an autopilot crash in Houston. I think it was maybe earlier this year or late last year, I don't remember when, but it was in Houston, made headlines, and the people they initially interviewed were super convinced that there was someone, there was no one in the driver's seat, and the car had just crashed itself into a tree and caught fire, right? And of course, they've done a thorough investigation now, and it shows that someone had their foot really, really hard down on the pedal, and absolutely it was not the car driving itself at the time. But of course, you don't hear that, right? The negative headline from the initial crash made a big splash, but we're not going to see a big splash now from the actual results in the investigation that show that that was not the case, and there was a human at fault. All right, and then the last one, and I think this is kind of a fun one and a good one to end on because it is instructive, is that a lot of the legacy financial media, they'll quote people that are, say, like in the industry, maybe a financial advisor or what have you, and these professionals, less so now, but definitely more in the past, have an incentive for what's called churn. So it used to be the case that there would be what's called loads, a front load when you first bought into a fund, and then a back load. So when you sold off the fund, there would be basically a commission, right? This would be an amount, a fee that you paid, which basically went to your broker, your financial advisor. And then there were also high fees during, annual fees while you were holding these funds as well. But because of those fees on the entry and exit, it was very much in the financial advisor's interests to have you constantly moving in and out of positions. So they would call you up and they'd say, hey Dan, the sector is underperforming this month. I think we should really do some sector rotation and move into something else. And so, of course, they get to make a commission on the sell, then they make the commission on the buy side into the new sector, and so on and so forth over and over. This is something actually that Matthew McConaughey's character talks about in the movie The Wolf of Wall Street, when he's having lunch with Leonardo DiCaprio's character. I'd play the clip for you, but they're really strict on copyright stuff. So anyway, if you've seen the movie, you'll know what I'm talking about. Matthew McConaughey talks about a couple of very odd strategies for keeping the stress off, and also maintaining productivity. But anyway, you can check that out if you want, and you can also put a link to that particular clip on a YouTube channel that I found in the description below. So I think that's a pretty good list for now of some of the nonsensical things that you'll see in the media, things to try to avoid and be a little bit wary of when you make your decisions for long-term investing. None of this stuff is really going to matter to you if you're going to be a set it and forget it long-term investor, where you just, you set up your plan, to be automatic, and then you just forget about it and let it ride until it's time for retirement. Although you may want to rebalance annually or that kind of thing, But I hope you found that fun and informational. If you did, please hit the like button and consider subscribing to the channel. Thank you very much for watching, and I will see you in the next video.